back to Personal Pension Radio. This is episode 255. This is a listener question. But before I get started, if you have not already heard episode 254, the piece about Proposition 19 and the changes in California, this is a call out to all of my California listeners. If you haven't heard the information about Prop 19, please go back and check out episode 254. It is a huge game-changing thing for property owners here in California. Those of you listening across the country, California and New York do give your state ideas. And yes, a lot of the crazy property tax and tax ideas that your state may have implemented or might be considering, they often come from California and New York, so you may want to take a listen to that as well. This episode, number 255, I want to cover a question that actually came in from Belinda. Now, before I do that, always the same disclosure. I am a certified financial planner. I am an investment advisor representative. With all of that said, please still don't act on things that you hear on this show as if you're getting advice for you personally. Please meet with a qualified, hopefully certified financial planning professional before you make any big decisions. I would love to be that person. You can always send me an email, Craig with a K at craigstrom.com. That's KRAIGSTROM.com. And I'm happy to help. I work with folks all over the country through the miracle of technology nowadays. So let's jump into this. Belinda writes this. She says, "Dear Craig," thank you. I love the use of dear. I say dear all the time, and maybe it's old-fashioned, but "Dear Craig, my husband and I found your podcast during a recent holiday road trip. Awesome. We listened to other podcasts, including Bigger Pockets and Clark Howard. That's fantastic that I'm on any listening list with great podcast examples like Bigger Pockets and Clark Howard. I think I'm flattered. That's awesome. We have been working on updating our retirement planning and recently met with a financial advisor near where we live in Texas. Hello out there in the great state of Texas. We met on Zoom due to COVID. Anyway, we found the advisor by way of a radio ad. She had a radio ad on Saturday morning radio. We met with her for a little over an hour, and she advised us that we should buy an annuity. My husband is 52 and I'm 53. What do you think? Thank you, Belinda." Now, I really appreciate the email. I appreciate the question. And those, again, who have listened to my show often, you know that I follow my own advice, my own disclosure, which says don't give out Dave Ramsey type information or advice on a soundbite, right? A soundbite where I just, get an email with very little data and then I give out blanket advice. So I did contact Belinda to get a little more information, okay? And that's very, very important. I can't stress that enough, that the idea of being able to give any kind of an answer on a short soundbite or a simple email, that is just malpractice. Now, of course, for financial entertainers, it's not malpractice because they're governed by free speech. They're not regulated as true financial practicing professionals. All right, now, quick review, right, that for the details for Belinda and her husband. I asked how much money are they dealing with, and it turns out it was $280,000 that had been rolled over from an old 401k. Now, before I dive into some of the specifics here, I want to do an overview of the types of annuities. That is very important. And when I talk about guaranteed annuities, it's important to know that guaranteed annuities are guaranteed by the claims paying ability of the insurance company that is issuing the annuity. Okay, that's very important. When we say guaranteed, yes, they are guaranteed, but there are folks on Wall Street, financial professionals, who will say very quickly, well, that's only guaranteed if the insurance company fails, it's not guaranteed. Just to be clear, I have searched for 24 years. I've asked and searched for 24 years, And those of you listening, watching on YouTube, Facebook, LinkedIn, podcast land, if you know the answer to this, if you have something different, please send me an email. But I've searched for 24 years. Never have I been able to find any record of any life insurance company ever defaulting on a guaranteed annuity. Ever. Never heard of it. I've talked to regulators. I've talked to people in state government offices that regulate insurance companies. Never heard of it. It's never happened. There's no record anywhere of such a thing happening. So, take it for what it's worth. A guaranteed annuity is guaranteed by the claims paying ability of the insurance company that issued the annuity. Now, a non-guaranteed annuity has investment risk. And it's exactly what it sounds like, non-guaranteed. There may be some guaranteed components built into a non-guaranteed annuity, but it's not guaranteed, right? That's the general idea. Now, there are things called guaranteed income annuities. These are essentially personal pensions. Hence, part of the personal pension radio is this conversation about how to build your own personal income stream, your own personal pension. And of course, that income is guaranteed by the insurance company, and we just went through that. So we start with the types of annuities being guaranteed income annuities, where people will put money away like a pension, similar, and someday it will pay a guaranteed monthly or annual income. My mother has two of them, and her two guaranteed annuities pay an income stream for the rest of her life, and she is so financially comfortable because of it. She doesn't have to worry about the stock market ever because she just gets a paycheck. Period. She gets three of them actually. Social Security, an annuity number one, and annuity number two. She's very happy with that. She has no market risks and her income is very secure. So that's an income annuity. Then there is guaranteed fixed annuity. Guaranteed fixed annuity is a lot like a certificate of deposit from a bank. Money is given to an insurance company. The insurance company says, all right, we're going to hang on to this money for this period of years, and we're going to give you a guaranteed 3% or 5% or whatever the number is. We're going to guarantee a fixed rate for a period of years, period of time. That is a guaranteed annuity. Now, there is a guaranteed annuity called an indexed annuity. This is where Belinda and her husband, this is where they end up. An indexed annuity is one where there is a minimum floor interest rate. A minimum floor interest rate that says no matter what, over the next 5 or 10 years, this guaranteed annuity will guarantee this much minimum floor interest rate. But the big ticket is that the interest that we're hoping to earn is actually indexed to a stock market index. It is using the stock market as a reference point only. Money for the client, money for the customer is not going into the market. That is really important. I hear that so many times over the years. I've got one of those annuities where my money's in the market and I guaranteed I'm not going to lose. Whoa, that's not the way it works. The insurance company puts their money in the market, but the customer's money is actually part of the general accounts of the company, and it is not in the market. They're using the market as a reference point to gauge how much interest would be placed on the contract. Okay, so the index is simply a reference point. Now, non-guaranteed annuities are just that. They are investment-based and they have risk. Things go up and down and you can lose money and you could gain money, and generally non-guaranteed annuities are more expensive, fees and so forth, than guaranteed annuities. And of course they carry a heightened level of risk. Now, the insurance companies, again, they all, and this is a very important piece, whether it's income or fixed guaranteed or index guaranteed or the non-guaranteed, they all swim in the same pool. What do I mean by that? The insurance companies are essentially gigantic bond investment portfolio managers. The insurance industry has been around for 100 years or more, 200 years. And they manage a very long-term perspective on investing. Slow and steady wins the race in the insurance world. They work on a very long-term, long history. So they're not out there trying to make home runs. They're just long-term. Those insurance companies, they all swim in the same basic business operating pool. Their portfolios are all very similar. There's no secret sauce. There's no magic bullet out there, okay? So here's the thing. I share that because what Belinda remembered when I asked her, I said, what do you remember about the annuity being recommended? Because I wanted to get a feel for what was being advised, what were they being recommended, what was being recommended. And this is what she said. She said she remembered a guaranteed rate of return of 6%. 6%, guaranteed rate of return. That sounds fantastic, right? Well, here's that thing. That doesn't exist. That is a red flag that she was not properly educated as to what was being sold. Now, if you back up, remember, she and her husband met with the financial advisor they heard on the radio, okay? And they met for a little over an hour, and they received a recommendation to put $280,000 in a guaranteed annuity. And what did Belinda and her husband presumably hear? Guaranteed 6%, right? That doesn't exist. There's no such thing as a guaranteed 6% guaranteed annuity. Now, like a lot of guarantees in there, right? The insurance companies, again, like I said, they all swim in the same pool. And there's no way for one insurance company to magically have a rate of return that's 90% better than every other insurance company. It just doesn't happen. So this is what was being recommended. A guaranteed annuity that was indexed to a stock market index. Granted, that particular account will not lose money because a market index goes down. If a market index goes down, they get zero. Zero as an interest rate. If the market goes up, they participate in the upside. Up to, here's the part, up to a certain cap, a certain limit, a certain percentage. There's no unlimited upside because the insurance company just said there's no downside. So if there's no downside, no market losses that pass through to the client, well, they're going to put a cap on the upside. That's how it works. So where did this 6% guarantee get stuck in Belinda and her husband's head? Where did that get? Oh, here's what it is. This guaranteed annuity says, we'll give you a guaranteed income rate in the future if you hold on to the contract for a certain period of years. We're going to guarantee your income in the future based on a 6% increase every year. Ha, sounds good. Isn't that a 6% guarantee? It's a 6% guarantee on the number we will use to calculate your income. That's the number. Did we say that your account value will go up 6% per year? No. What is said is that the number we will use to calculate your income in the future, that number will go up 6% every year. And then when you want income, remember, guaranteed annuities are really good for income. My mom has 2 of them, loves it. When we calculate your income, we'll look at that special calculation we've been doing on this side, and we'll look at your account value on this side. For those of you on the podcast, I am very visual with my hands. I'm holding up my hands. And we'll say this, that if the guaranteed 6% number is higher, we'll calculate your income on the higher number. If your account value, this is not your money. The guaranteed calculation, that 6% calculation, is shadow accounting. It's only used to calculate an income number in the future. It is not their money. This is their money, the account value. And if that's higher than the 6% guarantee, so be it. We'll calculate the income on whichever one is higher. Now, 6% guarantee doesn't come for free. That is generally a feature on a guaranteed indexed annuity that costs money. And if it's appropriate for a client, I'll tell you, I have clients right now that have guaranteed indexed annuities where that income calculation has just turned out awesome. It's going to be really good. We looked at one just yesterday that the income guarantee calculation is excellent. Client getting ready to retire, that provided the security to know that their income number was going to be high. It was going to be really healthy, very good. Now, does it work in every situation? No. Let me go through this, okay? Because it's a real question of what type of money are we dealing with. Remember, this is a $280,000 IRA that came from a 401k. All of that money is income taxable when they draw money out of it. So, what's the real goal of setting aside money in IRAs and 401ks? Isn't it maximum income someday? Maximum income if you can get it? So, if a guaranteed income annuity in the future provides more guaranteed or secure income than a market-based income, do we care whether or not we get higher income from a guaranteed source or lower income from a non-guaranteed source? I mean, yeah, a lot of folks want that security, like my mom, to have that higher income number. It's going to be taxable, so why not go after maximum income? That's really the goal, right? Maximum lifestyle income. So in this situation, an annuity in the future might make sense. However, at age 52 and 53 for Belinda and her husband, I'm not really comfortable with the idea of the two of them going hog wild all in on a guaranteed annuity that might have a 10-year restriction on pulling money back out. And we're in a very low interest rate environment right now. This may not be the best time to lock up dollars for 5, 10, maybe longer, 10 years or more. So I really wasn't a big fan of this idea, nor was I a big fan of the idea that they got this advice in 60 minutes, right? There's so much more that goes into this kind of planning. So when you look at it, remember that this is a situation where the decision to go into a guaranteed annuity comes with strings attached. They're called surrender penalties. And I don't mind surrender penalties if the use of the guaranteed annuity is right. Surrender penalties shouldn't matter if we're using the guaranteed annuity for the right reason. Hanging on to that annuity, no big deal, right? We don't need to worry about it. Now, there's a lot more to unpack with this. But the bottom line is this. I'm not sure any type of an annuity is right for Belinda and her husband at this time. Maybe in the future, but not yet. There's going to be a lot more conversation, and sure enough, there's a call scheduled with Belinda and her husband next week. So looking forward to that. If you have any questions about retirement income planning, guaranteed annuities, non-guaranteed annuities, income annuities, my mom and dad have this annuity in the drawer, just make sure you send me an email. Craig with a K, that's K-R-A-I-G, at Craigstrom, KRAIGSTROM.com. And we'll get in touch soon. Take care now. Talk to you soon. Bye.